Howdy, Jacob here. Today we're looking at Brightview Holdings in the commercial services and supplies industry. 1.2 billion market cap on 1.9 billion enterprise value. Growth is not entirely impressive, but you're looking at low single-digit growth rate. On the revenue side, gross margin down a little bit from 10 years ago. Operating margin just about 3%. It's a very low margin business here. Return on invested capital pretty poor because they've been in and out of making money. Doesn't look like that's due to R&D or anything, just cost of goods sold and then SG&A. Shares have been going down the last 5 years, so that's a positive. We'll see if they went into debt to do so, though. 67 million cash on hand, no short-term debt, 888 million long-term debt. Looks like they have diminished that long-term debt quite a bit from 2017, but let's see what it is in relation to cash flow. So on the cash flow side, let's be generous and say they have about 100 million a year in free cash flow. You have just about 8-9 times that to get to long-term debt. So most debt is due in 2 to 5 years on the long-term debt side, and so they're going to have to refinance because there's no way that they can afford to pay 100% of their free cash flow to that. I mean, there's a chance they do 100% of free cash flow to debt, and then somehow they, consistently make 200 mil a year. They can wipe that out, but that would mean that they don't have any other capital allocation to go towards making acquisitions, buying back shares, paying a dividend, or reinvesting back in yourselves. So it looks like their form of what they do with their free cash flow is make acquisitions. They buy back a little bit of shares, but nothing too crazy, and then been paying down a lot of debt. Okay, they actually issued a lot of preferred stock here to fund some of that debt pay down. But they do, like I said, still have 888 million long-term debt. So let's start making some assumptions here. On the revenue growth side, maybe just with inflation and then a PE below average due to the fact that kind of below average company in my perspective. Margins, maybe let's do 2 and 3, kind of a wide range. Let's just say they offset their stock-based compensation. So that would be 20%, let's say, of that 100 million going towards share repurchases. And then maybe 50% to acquisitions, leaving about 30% to debt reduction. And then honestly, even still, they'll probably still have a good amount of debt at that point, just 30% of capital allocation. 30%, 30 million, 200 million. They'll diminish that down to 600 million, but cash is still probably going to be similar. So, yeah, I think I'm pretty comfortable there. It's just not looking like it's obviously cheap. In a low margin business, low return on invested capital, you'd want to get this company extraordinarily cheap, and I don't think it's there yet. So, hopefully, you enjoy the video and have a great rest of your day. Thanks.